All right. What's up, everybody? It's P Flexico, 7 Up Trading. Um, Today we're gonna get a little bit on the topic of stock market investing. Okay, we want to basically get into why investing in the stock market is a good idea, and why you should think about going that route, taking that route. For me, um, I started learning about stocks. I say about I say around 2012. That's when I first started really learning about the stock market, and investing strategies, things like that. I was also into like real estate, learning about real estate and things like that. Uh, but the stock market just really caught my interest. It just really, was something that I really understood and something I was really interested in. And I also love business, so learning about companies and how they move and the prices and the way they work, what moves the prices and things like that. So that's really the reason why I got into the stock market. And then you don't have to have too much money to get into the market, to actually start investing. You don't need too much capital, but you do need some. All right. The first point of the topic is going to be potential for high returns. Now, this is one of the main reasons why I got in the stock market, because there's literally unlimited returns once you put your money into it and you understand how to print that money and how to make them investments, and keep your profits just rolling in. So, a quick stat: historically, the stock market has outperformed other asset classes like bonds and real estate. Over the long term, the average annual return for stocks has been around 7 to 10% after inflation. Now, 7 to 10% is a pretty good return on your investment. So, other investments you're going to see, like real estate, to give you somewhere around maybe 2 to 6%. I say if you do real well, and if you really know what you're doing, around 2 to 6%. But the stock market here, it averages an annual return between 7 to 10% after inflation. So you still have a chance to beat inflation while investing into the stock market. So these are one of the investments that can help you actually beat inflation. All right. Now, the second one, we're going to talk about compound growth. Now, compound interest is also another reason why I chose the stock market, because it's a way to automatically grow my money. You feel me? When you talking your money compounding, you talking about compound growth, compound interest. Okay, you're talking about automated system that's growing your money without you having to do anything. So, reinvesting dividends and capital gains can lead to exponential growth over time. The earlier you start investing, the more you can benefit from compound interest. Okay? And we're going to get a little bit more into compound interest and compound growth after we run through these points. Okay? Now, number 3 would be ownership in companies. Buying a stock means owning a piece of a company. As the company grows and it becomes more profitable, so does your investment. So when you buy a stock, you're owning a piece of a company. You're buying a a share of the company. And there's instances where if you own enough shares of a company, then yes, you would you will see that you'll be getting mail and you'll be getting things, different notifications about what's going on with the company and decisions being made and things like that. And we'll get into that a little more also. Okay. Fourth point, we're going to go passive income. Many stocks pay dividends. These dividends provide a regular income stream. You can reinvest your dividends to buy more shares, which will further boost your wealth in the company. It'll further increase your money. So that's how you can get passive income from you're investing in the stock market and investing in the company. From dividends and things like that. So yeah, that's passive income. All right. Now we got inflation hedge for number 5. Stocks have the potential to outpace inflation, helping to maintain or grow your purchasing power over time. Now, inflation hedge is something that when you're investing, you really, really want to worry about. You really want to think about, because you're investing. That's what you're really, that's really one of the main reasons you're investing, to basically be able to live the life you want to live and to be able to afford things. So if you're beating inflation, then your purchasing power is growing, and your money is worth, your purchasing power and your money is worth, is worth, your investments is worth it. Now your money have worth, even though we all know about the dollar and all that, but you want to, you just want to beat inflation. You don't want taxes and things to go up like that, and you'll be getting hit over the head every time you have to go pay something or spend some money. So that's another point. That's point 5. All right, now point 6 is diversification. Investing in stocks allow you to diversify your portfolio across different sectors and different industries, and that will reduce your risk. Okay? So you got stocks, you got bonds, you have ETFs, you have all types of things. You can invest in these indexes. You can invest in REITs. So there's many ways to diversify your portfolio. You can invest in companies from different countries, all types of things. So that's another point. Okay, we're going to talk number 7, which is liquidity. Stocks are generally easy to buy and sell, providing flexibility in managing your investments. So basically what I was saying in the beginning, stocks are pretty easy to buy, pretty cheap. You can find some cheap companies that can get you some pretty profitable returns, pretty solid gains. And, you don't have to put too much out. And of course, the more you put in, the more you get back, so make it worth your while, and just learn about the company and put your money where you think, you know the most knowledge. And it's not going to be hard at all. Buying stocks are very easy. 8 is going to be accessibility. With advancements in technology, advancing in the stock market is more accessible than ever. Many platforms allow you to start with small amounts of money and offer educational resources for beginners. Facts. There's plenty of people out here teaching us now. You can look on YouTube. You can, always check out 7up Trading. We're always going to have something educational about investing, whether it's stock market, whether it's trading, whether it's Forex, futures, whatever. We're always going to have something on here that you can click on and learn as long as you got a device. And it's just easy now. It's easy to learn. It's easy to invest. You got different apps. You got different brokers now. You don't have to do the old school go down to the banks or go down to the actual stock exchange and place your trade and do this and that. You don't have to do that no more. You can place it. You can literally trade right off of your phones, right off your computers, right off a tablet, anything. So accessibility is very great now due to the technology, and that's what it is. All right, number 9, long-term financial goals. Investing in stocks can really help you achieve long-term financial goals. All right, number 9, long-term financial goals. Investing in stocks can really help you achieve your long-term financial goals. Retirement, buying a home, funding for education, getting a dream car, anything, paying for your kids' school. You know, when you start investing, especially for the younger people, if you start investing now and start early as you can, then your long-term financial goal is going to be way more achievable. Your future is going to be way more lit. You're gonna understand. You're gonna be grateful and be like, okay, yeah, I understand now. I'm glad I did that. So invest. All right. And number 10 is going to be tax advantages. Certain investment accounts like IRAs and 401ks offer different tax benefits that can enhance your returns. So when you get yourself a good investment account, usually like a retirement account, these things have tax advantages for when you withdraw later on, when you're ready to take your investment out for retirement, maybe, or whatever, any occasion later on down the line. They have different tax advantages. So, just know that investing, it comes with risk, but the potential for rewards can outweigh the risk when you really understand the market and you approach it the right way. So just educate yourself, start small and consider a long-term strategy, and that's how you maximize the chances of being successful in the stock market. Okay, let's go back a little bit on the topic of compound interest. What is compound interest? Compound interest is the interest on a loan or deposit that is calculated based on both the initial principal and the accumulated interest from previous periods. So this means that not only do you earn interest on your original investment, but you also earn interest on the interest that has already been added to your account. All right. Now let's get a little bit on how does it work? How does compound interest work? Okay, first, you have the principal amount, which is the initial amount of money you invest or you get loaned. Okay, so it's the initial amount of money invested or loaned. That's the principal amount. Then you have the interest rate, which is the percentage of the principal charged as interest per period. Okay. The interest rate is the percentage of principal charged as interest per period. And then you have time. The number of time periods the money is invested or borrowed. So you have the time periods like years, months, etc. All right. And then you have the number of compounding periods, which is how often the interest is calculated and added to the account: annually, semi-annually, quarterly, monthly, and daily. So the number of compounding periods is how often the interest is calculated and added to the account. And so you got to remember, compound interest is very, very important. It's one of the best mechanisms of investing. Like, it's one of the best ways to grow your money, because especially finding assets like that have dividends, that pay dividends, getting equities that pay dividends, and then you let them just reinvest and just keep building and building. What I like to do is I buy dividend stocks, and when my profits come in from the dividends and things like that, I reinvest them and let them keep going until they build enough, because eventually you'll buy another share of the company. So it'll keep increasing your ownership while increasing your buying power. So it's always good to think about that and understand that. I'm gonna go over the formula for it in the video, but this is pretty much what it is. So you got A equals the amount of money calculated after blank years, after n years, which is the number of years, including interest. All right. P is the principal amount, which is your initial investment. R equals annual interest rate. So that's the decimal number you're going to see, which is the interest rate. Interest you're going to be paying. All right. N equals the number of times that interest is compounded per year. All right. And T is the number of years the money is invested or borrowed. So the equation would be A equals P times 1 plus R over N. All right. A equals P, and you put them in parentheses. You're going to multiply 1 plus R over N. Okay. So you got the amount of money accumulated after the years, which is how much money you accumulated. That equals, the equation for that is the principal amount that you invest times 1, which is the number of times it's going to be compounded, or however many. That number could be whatever, however many times you think your investment is going to be compounded, or however you set it up. But for this example, we have 1. So you got A equals P times 1 plus your interest rate over the number of times that interest is compounded per year. So you got A equals P times 1 plus R over N. Okay, and I'll put up a picture for the example so you can see it more clearly. So let's say, for another example, let's say you invest $1,000 at an annual interest rate of 5%, and you compound it and it's compounded annually for 5 years. All right, so P would equal 1,000, which is the principal investment. Your initial investment, your principal. R equals the interest rate, which is 5%. So it's 0.05. The number of times compounded annually is 1 time, because it's 1 year. You're looking at it for a year. And then T equals 5, which is 5 years. Okay. Number of years is 5 years. So you're looking at it for 5 years. So you're looking at what's the outcome of a $1,000 investment with the interest rate of 5% compounded for 5 years. Okay. So you do the math. A equals 1,000. Okay. Do 1,000 times 1 plus 0.05 over 1. All right. So then you have A equals 1,000 times 1.05, because when you're going 1 into 0.05, it's 0.05. So now you have 1,000 times 1 plus 0.05. Okay. All right. So 1,000 equals $1.05. Okay. A equals 1,000 times $1.05 to the third power. Okay. And that equals 1,000 times 1.27628. All right. And the number would be $1,276.28. All right. So it's a little confusing, of course, but once you see it, you'll get it. You'll understand it. I just broke down the formula real fast. So, all right. So always understand the importance of compound interest is wealth building. So over time, compound interest can significantly increase your investment, especially if you start early and let it grow. Time factor, the longer you keep your money invested, the better your outcome is going to be, the better the effects of compounding will become. Okay. And strategies, you got to understand compound interest, it's essential for making informed investment decisions, whether, in the stock market, bonds, or whatever. So you want to understand it and make sure that you calculating these numbers together and making sure everything is making sense to you. You don't want to just be making investments and not, gaining the right proceeds that you could be potentially gaining. All right. So just always remember, compound interest is a powerful financial concept that can lead to significant growth of your investment over time. Okay. By investing early and allowing your money to compound, you can maximize your financial potential.